$240 billion. That's not a guess. It's not a worst-case scenario. That is the estimated exposure major financial institutions currently hold in short silver derivatives. And when those bets blow up, guess who's going to pay for it? You are, through inflation, through bailouts, through the silent theft of your purchasing power, all to rescue banks that made reckless bets against a metal they simply cannot control. This isn't a conspiracy theory. This is just math. It's exposed in regulatory filings, hidden in footnotes, and buried in derivative disclosures that are designed for nobody to read. Welcome to the Wealth Radar S. Today, I'm revealing the emergency mechanism already in place to rescue these silver shorts when the squeeze finally hits. I'll show you the Fed as playbook, the same one they have used before, and explain why your silver position might be the only thing that protects you when the bailout bill comes due. They are hiding this from you in plain sight. Let me show you everything. Last month, I was analyzing the quarterly derivatives report from the Office of the Comptroller of the Currency. This is a public document released every quarter, and it contains the derivative exposure of every major U.S. bank. Most people never read it. It's 30 pages of dense tables and technical jargon, basically designed to be ignored. But buried on page 17, in a table labeled Precious Metals Derivatives by Maturity, I found something that made my stomach drop. 4 U.S. banks hold a combined notional exposure of $243.7 billion in precious metals derivatives, and the vast majority of that is concentrated in silver. Let me put that number in perspective for you. The entire annual silver mining production, globally, is worth about $25 billion at current prices. This means these 4 banks have derivative exposure equal to nearly 10 years of global silver production. Most of that exposure is in short positions, bets that the price of silver will go down. Now, here's the terrifying part. If silver rises significantly, if it doubles or triples from here, the losses on those positions would exceed the capital reserves of those banks. They would become insolvent, unable to meet their obligations, and face a complete collapse. And when major banks face collapse, what happens? The Federal Reserve steps in. We see emergency lending facilities, liquidity injections, and bailouts by another name. We've all seen this movie before, in 2008 with mortgages, in 2020 with the repo markets, and again in 2023 with regional banks. The playbook is always the same: private profits when their bets pay off, and socialized losses when their bets fail. But this time, there's a critical twist. Because unlike mortgage derivatives or repo agreements, silver is a physical commodity. It exists in the real world. You can't print it. It can't be created with clever accounting entries. When the silver shorts are forced to cover their positions, they need actual physical metal. And if that metal isn't there, no amount of Fed intervention can magically make it appear. The bailout mechanism is ready, but this time, it might not be enough. Let me show you exactly what they're preparing for. Before I continue, let me be perfectly clear about my sources. The $243.7 billion figure comes directly from the OCC quarterly report on bank trading and derivatives activities. It's in Table 9. You can download it from the OCC website right now and verify it for yourself. The fact that it's concentrated in silver, not gold, comes from cross-referencing CFTC commitment of traders data with bank-level position disclosures. It's not a perfect science, but it's directionally very clear. The Fed's emergency lending mechanisms are all documented in their own publications. The primary dealer credit facility, the bank term funding program, the overnight repo operations. It's all public. It's all available for anyone willing to do the reading. I'm not making claims I can't support. Everything I'm showing you today is derived directly from government data and regulatory filings. The analysis is mine, but the data is theirs. And that's what makes this so incredibly frustrating. The evidence is public, but it's scattered, it's fragmented, and it's buried in documents that nobody reads. Here at the Wealth Radar S, we connect the dots. We do the reading so you don't have to. Now, I know some people will say I'm being alarmist. They'll say that $240 billion in notional exposure does not mean $240 billion in actual risk. They'll argue that these derivatives are hedged and that banks have sophisticated risk management. Those are fair points, and I'm going to address them. Because when you look at how those hedges are constructed and what happens in a real physical squeeze, the picture gets even more concerning. Keep watching. Ask yourself this: if the positions are fully hedged, if there's no real risk, why do banks fight so hard to keep these positions secret? Why did they lobby against derivative transparency? Why did they settle manipulation charges for billions of dollars rather than go to trial? You don't pay billion-dollar settlements to protect positions that aren't at risk. Something is there. Let me show you what it is. To understand the $240 billion problem in the silver market, you need to understand how it was created. It didn't happen overnight. It built up over decades, layer by layer, trade by trade, until the position became so large that unwinding it would crash the entire market. Let me walk you through the mechanics. It starts with layer 1, lease operations. For decades, central banks have leased their gold and silver to commercial banks. The central bank gets a small interest payment, and the commercial bank gets physical metal it can sell into the market. But here's the trick. The central bank still counts that leased out metal as a reserve asset, and the commercial bank now has cash from selling metal it doesn't actually own. It's borrowed metal that both parties count as an asset. This works just fine, as long as no one asks for the metal back. But if the central bank ever recalls that lease, the commercial bank has to buy all that metal back on the open market to return it at whatever the current price happens to be. If the price has risen significantly, that's a massive, massive loss. Next comes layer 2, futures selling. Banks discovered they could suppress the price of silver by selling futures contracts. They weren't selling physical silver they owned. They were selling promises to deliver silver in the future. Each contract represents thousands of ounces. If you sell enough of these contracts, you create a flood of paper supply that doesn't physically exist. The price goes down because the market sees more supply than there actually is. This works as long as nobody demands physical delivery. As long as the contracts are just settled in cash, the paper game can continue. But if delivery demands spike, the paper supply has to become real, physical supply. And the banks have to find the metal at any price. Then we get to layer 3, over-the-counter derivatives. Beyond the regulated futures market, there's a massive, shadowy derivatives market where banks trade directly with each other, with hedge funds, and with industrial users. These trades are largely unregulated. Reporting requirements are minimal, and position limits don't apply. This is where the real exposure lives. That $240 billion you see in official reports, it's mostly here. Private contracts and bilateral agreements, all hidden from public view. And here's the problem. These contracts are all interconnected. Bank A has a contract with Bank B. Bank B has an offsetting contract with Bank C, who has exposure to Bank D. On paper, it looks like everyone is hedged. But in reality, if any single link in that chain breaks, the whole structure can collapse like a house of cards. This brings us to layer 4, the short squeeze risk. Now, let's put it all together. The banks have leased metal they've already sold, they have futures contracts they can't possibly deliver on, and they have massive OTC derivative exposure with interconnected counterparty risk. If the price of silver rises significantly, all of these positions start losing money at the same time. The lease obligations become unaffordable. The futures contracts face delivery demands they can't meet. The OTC contracts trigger margin calls they can't pay. The banks simply don't have the capital to cover these simultaneous losses. Based on my analysis of the reported positions, a doubling of the silver price could create losses somewhere between $80 and $120 billion across the major banks. What if the price triples? The losses could approach the full $240 billion notional exposure. That's not survivable, not without intervention. So what happens next? The banks go to the Federal Reserve. They explain that the silver market is breaking and that it threatens the stability of the entire financial system. They argue that their failure would cascade through their counterparties, causing a systemic crisis. And the Fed, faced with another too-big-to-fail moment, does what it always does. It prints money. It provides loans. It bails them out. The mechanism is already in place. The playbook is already written. The only real question is when it will be used. Ever wonder what happens when the big players in finance get caught on the wrong side of a trade? They don't just lose money like the rest of us. They change the rules of the game. Let me show you the playbook and what it means for the coming silver squeeze. First, let's look at the nickel precedent. In March 2022, the London Metal Exchange experienced a massive short squeeze in nickel. A huge Chinese company had built an enormous short position, betting the price would go down, but it didn't. It skyrocketed. They faced margin calls they couldn't possibly meet. So what did the exchange do? Did they let the market work? No. They halted trading for a whole week. They canceled billions of dollars in legitimate, profitable trades. They literally changed the rules after the fact to save the shorts. The traders who were long, who had won the game fair and square, had their profits stolen by a regulatory decision. No government bailout, but the effect was the same. The shorts were protected, the longs were punished. Then, a year later, in March 2023, came the Bank Term Funding Program. Remember when Silicon Valley Bank and Signature Bank collapsed? The Federal Reserve created this program literally overnight. It allowed banks to borrow money against their treasury bonds at face value, even though the market value of those bonds had crashed. This was a stealth bailout. Banks were drowning because of their bad bond investments. But instead of letting them fail, the Fed created a magic wand, lending them money against assets that were worth far less than the loans. All this with no congressional approval, no public debate, just emergency action to protect the system. So what happens when the silver shorts, who have suppressed the price for decades, finally face their day of reckoning? I believe we'll see a combination of these tactics. It's a predictable pattern. First, the exchange will step in. The CME will dramatically hike margin requirements, just like they did in 2011 when silver hit $49. Back then, they raised margins 5 times in just 8 days. This forces smaller long players, the retail investors, to sell their positions because they can't afford the new requirements. It's a pressure release valve for the big shorts. Second, expect trading halts. If the price moves too quickly, they'll hit the circuit breakers. They'll suspend trading, citing the need for an orderly market. In reality, this is just a tactic to stop the squeeze in its tracks and prevent the price from reaching its true discovery level. Third, look for the Fed's lending facilities. Banks will get access to emergency cash. They'll be allowed to pledge their deeply underwater silver derivatives as collateral. The Fed will lend against these worthless positions, just like they did with the Treasury bonds. It's another backdoor bailout. Fourth, get ready for the narrative war. The financial media will spin the story. They'll blame speculators and market manipulation from retail investors. The narrative won't be about the banks and institutions that built impossibly large short positions. It will be framed as a story of market dysfunction caused by the little guy. And finally, if all else fails, they'll resort to cash settlement. The exchanges will declare force majeure. This means your futures contract, which promises you physical delivery of silver, will be settled in cash at a price far below the real market value. Physical delivery will be suspended. The shorts will walk away, saved from ruin. The longs will be robbed. And we all pay the price through the inflation that comes from the Fed, printing all this emergency money. This isn't a secret conspiracy theory written down somewhere. It's just the logical playbook based on how they've handled every single crisis before. We saw it in 1980 when the Hunt brothers tried to corner the silver market. The exchange changed the rules mid-game to liquidation only, crashed the price, and saved the banks who were short. We saw it in 2008 when the Fed bailed out Bear Stearns and its massive precious metals derivative book, handing it over to JP Morgan. The pattern is clear. In every case, the system protects itself. The rules are bent. The game is rigged to prevent catastrophic losses for the institutions at the center of the financial world. The only way to escape this trap is to own the real thing. Physical metal, bars and coins that you hold in your own possession, outside the system, beyond the reach of exchange rules, emergency decrees, and backdoor bailouts. That's the real secret they don't want you to know. Retail traders couldn't meet the calls. They liquidated. The price crashed 35% in weeks. The shorts covered at much lower prices, and the squeeze was broken. The CME faced no consequences for its convenient timing. Then, in 2022, we had the nickel cancellation. I mentioned this earlier, but it's so important it bears repeating. The London Metal Exchange canceled $3.9 billion in legitimate legal trades just to protect shorts. Traders who had followed the rules and profited saw their gains completely erased by an executive decision. This wasn't a bailout. It was something worse. It was a retroactive rule change that stole from the longs to give to the shorts. This is the history. This is the pattern we see over and over again. When powerful short sellers face destruction, the rules suddenly change. When big banks face massive losses, the system intervenes. And I believe it will happen again with silver. The only question is whether you'll be positioned to survive it when it does. Now, I know the objections are coming, so let me address them head on. First, the $240 billion figure is just notional value. The real exposure is much smaller. And that's partially true. Notional value does overstate the actual risk because many of these positions are hedged. But let's be conservative. Even if the real exposure is only 20% of that notional value, we're still talking about $48 billion. That's larger than the capital buffers of most major banks. And in a real crisis, hedges fail. Counterparties default. That net exposure can become gross exposure very, very quickly. Next objection. Banks have sophisticated risk management. They wouldn't take existential risks. Really? Tell that to Bear Stearns. Tell that to Lehman Brothers. Or, more recently, tell that to Credit Suisse. Sophisticated risk management didn't save them. All it did was give them the confidence to take on even bigger risks. Banks consistently underestimate these rare, catastrophic events, what we call tail risks. It's built into their compensation structure. Traders get huge bonuses for short-term profits and just walk away when their positions eventually blow up, leaving others to clean up the mess. And finally, the Fed would never bail out silver shorts specifically. Of course, they won't call it that. They'll use neutral language. They'll call it stabilizing commodities markets or preventing systemic contagion or ensuring market functioning. The language is always sanitized, but the effect is always the same. Shorts get rescued and longs get punished. Does this sound like a conspiracy theory? Well, what's a conspiracy theory? It's simply an unproven explanation for an event. But when the same event happens repeatedly with the same players and the same outcome, at what point does it stop being a theory and start becoming an observable pattern of behavior? They say it's just monetary policy. They call it market stabilization. But I'm looking at the data straight from the OCC and the CFTC, and I'm looking at history. When you see the same players getting bailed out time and time again, that's not a coincidence. It's a system designed to protect itself. And today, I'm going to show you exactly how to navigate it. Let's break down how I'm positioning myself against what I see coming. First, and most importantly, physical over paper. Forget the ETFs, the futures contracts, the pool accounts. Those are the first things that will get hit in a crisis. Think margin calls, trading halts, forced cash settlements, and sudden rule changes. When you hold physical metal in your own possession, you're outside that system. There's no counterparty risk. No exchange can change the rules on you. Your metal doesn't care about their game. Second, geographic diversification is key. Don't put all your eggs in one basket, and don't keep all your metal in one location, especially not all within the reach of a single government. I'm talking about secure, allocated storage in different, stable jurisdictions. Think about places like Singapore, Switzerland, or the Cayman Islands. If a government decides to intervene, it's often country-specific. Spreading your assets around minimizes that single point of failure. Third, and this might be the hardest part, ignore the noise. When the interventions start, and they will, you'll see margin requirements skyrocket. Trading will be halted. The mainstream media will be screaming about reckless speculation. Your job is to do nothing. Don't sell. Don't panic. Just hold your physical metal and let the storm pass. These moves are designed specifically to scare you, to shake out the weak hands and force you to sell. They need your metal to cover their massive short positions. Don't be their exit liquidity. Fourth, prepare for chaos in the paper markets. If and when exchanges declare force majeure and decide to settle futures contracts in cash instead of physical metal, things will get wild. The paper price you see on the screen might crash, but at the same time, the premium you pay for physical metal could explode to unheard of levels. In that moment of dislocation, if you have any dry powder, that's your signal to buy every ounce of physical you can find. The paper price becomes irrelevant. The only thing that matters is the price for metal you can actually hold. Fifth, you must extend your timeline. The powers that be have a lot of tools to delay the inevitable. They can suppress the price for months, maybe even for years, but they can't create silver out of thin air. Eventually, the fundamental reality of physical supply and demand will win. The gap between the paper price and physical availability will become too wide to ignore. Your greatest advantage is patience. The banks have to report their numbers every quarter. Fund managers face pressure from investors every year. You don't have an external timeline. Use that to your advantage. And finally, my sixth step, document everything. Keep meticulous records of all your purchases. The dates, the prices, the dealers you bought from. Have proof of your physical holdings. If the situation gets extreme, with confiscatory actions or punitive taxes, having documentation that proves you're a long-term holder could provide crucial legal protection. Let me leave you with this one staggering fact. There is a $240 billion short position in the silver market. The banks holding these positions simply cannot cover them if the price of silver makes a significant move up. The system has mechanisms ready to bail them out when it happens, and you'll be the one paying the bill through inflation and rigged rule changes. This isn't a wild prediction, it's just math. The one thing they cannot control, the one asset they cannot bail out, is physical metal held in private hands far away from their system. The one thing they can't manipulate is the silver they can't touch. That's the real secret. It's not the bailout mechanism itself, but the fact that you have an escape from it. Physical silver is your opt-out clause from a game that's been rigged against you from the start. If this opened your eyes to what's really happening, subscribe to the Wealth Radar S and make sure you hit that notification bell. Every week, we expose what the financial system doesn't want you to know. Now, drop a comment below and tell me, are you positioned in paper or physical? I want to hear your strategy. This is the Wealth Radar S. See what they don't want you to see.